So let's look at some practice problems for Chapter 3. And the first question is a true-false. And it says the annual report contains four basic financial statements: the income statement, the balance sheet, the cash flow statement, and statement of stockholders' equity. And actually, that is true. That is what the annual report contains. And question 2, which of the following items is not normally considered to be a current asset? So accounts receivable is a current asset, so it's okay. Inventory is a current asset. Bonds are not, they are a long-term liability. Cash is a current asset, and short-term highly liquid marketable securities are also current assets. So the answer was C for number 2. And then question 3, which of the following items cannot be found on a firm's balance sheet under current liabilities? So again, cannot. So accounts payable, it is a current liability. Short-term notes payable to the bank, that's a current liability. Accrued wages is a current liability. Cost of goods sold, this is an income statement item. So an income statement item, not found on the balance sheet at all. And then for E, accrued payroll taxes, that's also a current liability. So now for question 4, we've got, actually, let me reduce the size of this so we can read the question. So 2010 and 2011 year-end balance sheets for Tran Enterprises. And so don't worry because you see so much data. If you actually look at the question, it's not that bad at all. And so I kind of look all the way down here first, which of the following statements must be correct. And then I look at what they're saying in some of these answers. So the firm increased its short-term bank debt in 2011. So short-term notes payable, that would be that. So if I look from here to here, it went from 1800 or 1.8 million to 1.6 million. So it did not decrease, or I'm sorry, it did not increase, it decreased. So that's not correct. The firm issued long-term debt in 2011 for B. So long-term debt, 2.4 million equals 2.4 million. So it didn't issue, it stayed the same. And then B, the firm issued new common stock in 2011. So if I look at common stock, it went from 2 to 3, 2 million to 3 million. So actually, yeah, that happened. The firm did issue new common stock because we can see that balance increased. And then let's look at the other ones to see why they're wrong. The firm repurchased some common stock. Well, we would have seen the common stock would have decreased, so that one's incorrect since it increased. Okay, and then if we look at E, the firm had negative net income in 2011. Well, we can look at retained earnings. I have to get my pen back here. So if I look at retained earnings, and it went from 580,000 to 664,000. So when you have a positive net income, that increases your retained earnings. So they had a positive net income because retained earnings went up. And then we've got a calculation question, number 5. So Bauer Software's current balance sheet currently shows total common equity of 5.125 million. The company has $490,000 or 490,000 shares of stock outstanding, and they sell at a price of $27.50 per share. So that's the market price. And the question is, by how much do the firm's market and book values per share differ? Well, we just need to take the difference between the market price per share and the book price per share. So usually this is denoted book value per share, and it would just be what's on the balance sheet for common equity. And it said that it was 5.125 million. So I'll just put it in millions. And then divide it by the number of shares outstanding. It says it has 490,000 shares. And so you get a book value per share of $10.46. And we already know the market value per share is $27.50. So the difference is $27.50 minus $10.46. And that equals a difference of $17.04. So that's answer D. And so let's look at question 6. Preza's company's balance sheet showed total current assets of $2,750, all of which were required in its operations. Its current liabilities consisted of $975 of accounts payable, $600 of 6% short-term notes payable to the bank, and $250 of accrued wages and taxes. So they basically just told us the current assets and then listed the current liabilities. What is its net operating working capital? And so the formula for that, it's usually, we say NOWC for net operating working capital. It's current assets minus current liabilities minus notes payable. So they gave us current assets 2,750 minus, and then current liabilities would be the sum of the 975, the 600, and the 250. Now you could do this one of two ways. You could just add up all the current liabilities and subtract notes payable, or you could just add up accounts payable and accrued wages. So I'll just do it the way that it says. Current liabilities is really 975 plus 600 plus 250. That's the true current liabilities, and then minus the notes payable of 600. So we're really going to, this part and this part are going to zero out. So once we subtract those values from the current assets, we get 1,525. And so that's answer E. And then question 7, Rayo Construction recently reported $20.50 million of sales, $12.6 million of operating costs other than depreciation, and $3 million of depreciation. It had $8.5 million of bonds outstanding that carry a 7% interest rate, and its federal plus state income tax rate was 40%. What was Rayo's operating income, or EBIT, in millions? So always the way to get this is to take sales minus operating costs minus depreciation, and that gives you EBIT, or earnings before interest and taxes. So they said sales was 20.5, operating costs were minus 12.6 million, and depreciation was 3 million, so minus 3 million. And then when we subtract that, we should get EBIT of 4.9 million. And so that's answer D. And so if we go to question 8, Brown office supplies has this amount of sales, operating costs, depreciation, bonds outstanding with a 7% interest rate, and its tax rate is 40%. And it says how much was the firm's earnings before taxes, so just EBT. And so for this one, you'll want to write down that you have sales minus operating costs minus depreciation. Whoa, sorry about that. Minus depreciation. My hand hit something. And then you get your earnings before interest and taxes. And then you subtract your interest expense. And then you get what they're looking for, earnings before tax. So we look up and find our sales, 18,500. Operating costs were 8,250, so 8,250. Depreciation was 1,750. And so if I subtract those two, I get earnings before interest and taxes of 8,500. And then interest expense, I have to do a side calculation, and it's going to equal the $9,000 worth of bonds times the coupon rate or interest rate. And so 9,000 times 7% is $630 worth of interest expense. So I take that number over here and put minus 630, and then I get the answer, which is 7,870. And that's answer C.